Welcome to the Absolute Wealth Advisors May update from an investment and economics perspective. Anthony McInnes is here as well. For those wanting to see Paul, unfortunately, he's on holidays this week over in Perth, so you will have to look at Anthony and I for the next 5 to 7 minutes. Hello, Anthony. How are you today?
Hey, great. Thanks, Dean. It's my birthday today. Hi, everyone.
Oh, I didn't know. So happy birthday to Anthony. Good to see that Ant's working on his birthday as well. So, happy birthday to you. What we'll dive into, Anthony, just first and foremost, from my perspective, a little bit of an economics update of just things that we're seeing in the economy overall. As we know, yesterday, the Reserve Bank increased interest rates after pausing for 1 month. The volume of data from their perspective, they're still seeing inflation on the upward trend. Obviously, a little bit of a bounce in house prices makes them a little bit concerned as well. And so the decision was made to increase interest rates by 25 basis points or 0.25%. From an economics perspective, though, we're still seeing the economy to be relatively strong in Australia. And so we're actually projecting that the government's going to have a surplus for this financial year leading into the budget, which means their tax receipts is greater than this year's spending. So if you think about it from the personal perspective, there's no new net debt as a result of that, but the spending is less than what they've received due to predominantly more people being employed, which is great, and larger tax receipts from the commodity booms as well that's going on at the moment. The other positives for the Australian economy overall is that we've fast tracking and increasing the amount of immigration, especially skilled immigration. If we go back over Australia's history, obviously there's been a lot of immigration over our years, and it's actually been shown to be a really good boost to economic activity, notwithstanding the increase in interest rates. And finally, the probability of an Australian recession seems to be lower. It may still happen. It may be somewhat short-lived, but there's a lot of positivities in our economy nonetheless in terms of what's going on from an economics perspective, notwithstanding that the cost of living pressures are real in terms of the current inflation. So a couple of things that I'll hand over to Anthony to talk about is one of the things that he's been having conversations with clients. It's a little bit about the allocation to cash and term deposits and why that's good and why we're doing it at the moment. So Ant, tell us a little bit.
Yeah, so the use of cash and term deposits in a portfolio has two really important reasons. One, at the moment, it does give you flexibility to meet additional expenses or even additional investment if the market sort of dictates that. But it also, at the moment, term deposits are relatively giving a really stable, strong return to portfolios with maturities of over 12 months. We're looking at over 4.5% in a lot of cases now, which, as that guaranteed income comes in at the moment, it's a reassuring sign compared to some of the volatility that we're seeing in the markets. I will just add as well that on the inflation side of things, that obviously plays a role in the real return, so inflation adjusted return. So even though term deposit rates are 4.5%, with inflation still high at 7%, this time in a year's time, probably that value of that cash in pocket still going to be a bit lower. So that's for that reason, it's not the time to go 100% in term deposits, 100% in cash, because you miss out on a lot of those real returns and real gains.
Yep, absolutely. And the other thing, Ant, in terms of inflation that we've been making some clients aware of as well is the HEX debt or HELPS debt, amongst others. What's the inflation increase this year on that?
Yeah, historically, it's been the best loan you can get with the indexation, but in real terms, it's actually an interest rate, but of close to 2%. But now with inflation high, because it is indexed to inflation, it's about 7% that the indexation will happen. And that is based on the balance of any outstanding debt as at the 1st of June. So not the end of the financial year, but the 1st of June.
1st of June in arrears or advance?
In arrears. So
yeah,
it'll look at, yes.
So I think my brother alluded to this for me as well, that it was the debt that you had on the 1st of June last year is getting indexed by 7%, not the debt that you have on the 1st of June coming. So the bill will be large. Why does that matter for our clients? Is we want to make sure that some of our clients want to think about helping their children through university, through school, obviously, as the first step. And sometimes they say to us that the child can use the help hex system to fund their university fees. They've received enough help along the way, which we completely respect. But it's also just fair to know that just in terms of those kids, if they do have the hex debt, that it's going to increase by that level. Not saying that you want to or have to help them, but just be aware of that as well. And that goes as well to just generally the expenses that we're seeing from a client perspective. Is obviously we're needing to think about and review those budgets. We've made lots of assumptions with our clients about what their spending rates are. And at the moment, not everything is going up, but it's good for us to always be thinking about our budgets with our clients to make sure that we're spending within the targets that we've set ourselves over time. And what's a couple of the things that you've been talking about with clients in relation to where savings might be looking to be made?
The first is an insurance review. Insurance, it's something that no one likes paying, but unless you get paid. But then the flip side is it's probably an event's happened that you didn't want to happen.
Yeah.
But making sure that insurance needs are still appropriate for clients, and we're seeing opportunities to either reduce insurance if over time their other debt or other expenses have decreased.
Yep.
Or they're just willing to take on a bit more risk themselves, and so we can reduce premiums that way.
Yep, absolutely. And we were joking earlier that I had recently increased the excess on my home insurance. So I found that I only had $1,000 excess on home insurance, the physical building. And so Anthony and I were discussing the idea that if we were willing to take on just a little bit more risk in that context of moving it, I moved it up to a $5,000 excess. And that actually dropped the premiums quite significantly when I went to renew. And so I'm trying to ensure for the catastrophic event that the tree falls on the house or it burns down. And so overall, if the house got rebuilt and I was paying an excess of $5,000 instead of one, I would still be happy that the house was rebuilt. And so in that other insurance world, think about how you want to manage the risks of small things happening in your car or your house versus large things happening to your cars and house. That can obviously lead to some changes as well. The budget's coming up as well, and it's always an exciting time of year for us. Exciting or frustrating because ultimately rules get changed at the budget and they don't tell us until budget night. And so sometimes the Treasurer hints at a couple of things that they may be changing. The only thing that's been hinted at the moment as discussion is actually paying employee superannuation on the same day that you pay wages to your employees. Overall, I think that could be considered the right thing to do. Superannuation is employees' money. It's just going to a different bank account, if you can liken it that way. And so if we can pay it at the same time, I think that would be good overall for employees, and employers should be ready and able to do that as well, especially with some of the software changes that have happened of late. And anything else that comes to mind for you?
Look, no one knows what's going to happen tomorrow. There could be another assassination attempt on Putin, or some other global macroeconomic event that comes from nowhere. So we're telling all our clients to hold on at the moment, stick to the long-term strategy, and not worry about those short-term ups and downs.
Yep, absolutely. Well said. So a couple of other things that's happening at the moment is that we've started to do internally our tax planning preparation. So if there's anything that we need to do with you before 30 June, you'll hear from us over the next few weeks in terms of the preparation. And then we may be asking you to move money around or make contributions or something to that nature before 30 June. So please be ready for that. And the other thing is, yesterday I did a webinar, which some of you may have watched already, but you'll see the link in your email probably before this video. But we were calling out and wanting to educate everyone in relation to cybersecurity, and just all of us being a little bit more aware of the increased attempts to fraudulently access bank accounts, pay bills, get our personal information. And so we're really cognizant of this internally at our business, but it's a partnership, because ultimately the way in which scammers succeed is unfortunately through human error. And so we want to just call out and educate everyone through that process. So if you haven't watched that video, it's also on YouTube. It's a great watch. I interview our IT partner, and probably there's 2 or 3 jokes in there as well for you to laugh at. So that's another thing to do, but that's all for today. If you have any questions, of course, reach out to your advisors, Paul, Stella, or Anthony, and we can definitely answer those questions. And if you've got any comments or videos or any content that you'd like to hear in the future, please reach out and let us know. We'll be happy to continue this education journey. Until then, have a great day. Cheers.